Have you ever wondered how to start investing in the stock market? Well, you're not alone. The stock market is an intriguing place, a bustling hub where companies and investors intersect. It's a venue where companies, large and small, raise capital. They do this by selling shares of stock to investors like you and me. When you buy these shares, you're essentially buying a piece of that company, making you a part owner. There are two main types of stock: common shares and preferred shares. Owning common shares gives you voting rights, allowing you to have a say in the company's decisions. On the other hand, preferred shares may not give you voting rights, but they do give you a priority claim on the company's earnings and assets, especially during liquidation. The stock market is like a grand marketplace, a gathering of buyers and sellers. It's not a direct transaction with the company, but rather a purchase from another investor on the exchange. It's a dynamic ecosystem that has been around since the 16th and 17th centuries in Europe and since the late 18th century in America. Now that we've grasped what the stock market is, let's delve into how you can start investing. Before diving into the world of investments, it's crucial to do your homework. In the realm of stock market investing, knowledge is power. The more you understand about a company and the market trends, the better positioned you are to make informed decisions. Doing your research isn't just a recommendation, it's a necessity. So, how do you go about doing this research? Well, there are several ways to get started. One of the first steps is to learn about the company you're considering investing in. This includes understanding the company's business model, its competitive position in the market, and its financial health. Company websites are a good starting point for this information. Next, study the market trends. This involves understanding the overall direction of the market and the factors influencing it. You can gain insights into market trends by following financial news outlets and subscribing to financial blogs. These platforms provide up-to-date information about market movements, economic indicators, and other factors that can impact stock prices. Understanding financial reports is another crucial aspect of your research. Financial reports provide detailed information about a company's financial performance, including its revenue, expenses, and profits. They also give insights into a company's assets, liabilities, and shareholders' equity. Reading and interpreting these reports can seem daunting at first, but with time and practice, it becomes easier. Beyond these, there are other resources available for research. These include analyst reports, industry journals, and investor presentations. Each of these resources provides a different perspective, helping you to form a comprehensive view of your potential investment. Remember, investing in the stock market isn't about making quick decisions based on gut feelings. It's about making informed decisions based on thorough research. It's about understanding the risks and rewards associated with each investment and making choices that align with your financial goals. Research is your best tool to make informed decisions when investing in the stock market. Investing without a goal is like sailing without a compass. Setting clear and realistic financial goals before diving into the world of investing is a critical step. It's akin to setting the destination for your financial journey. Without these markers, you're essentially sailing in the dark with no clear direction or end in sight. Let's break it down. When we talk about financial goals, we're referring to what you want to achieve with your investments. Are you saving for a house, planning for retirement, or building a college fund for your child? Or perhaps you're looking to create an additional income stream. Whatever your aspirations, defining them will guide your investment choices and strategies. Now, financial goals can be categorized into two main types: short-term and long-term. Short-term goals are those you hope to achieve within the next 5 years. This might include saving for a vacation, buying a car, or setting up an emergency fund. On the other hand, long-term goals are those that will take more than 5 years to achieve. This typically includes retirement planning, buying a house, or saving for your child's education. The type of stocks you'll invest in can be influenced by the nature of your financial goals. If you're looking at short-term goals, you might want to consider less volatile stocks or even diversifying into bonds and mutual funds to protect your capital. For long-term goals, you might lean towards growth stocks that have the potential for higher returns over time, despite the possible short-term fluctuations. But remember, setting financial goals isn't a one-time event. It's a dynamic process that requires regular review and adjustment. As your life circumstances change, so too might your financial goals and risk tolerance. The key is to stay flexible and adapt your investment strategy as needed. And let's not forget, while investing can help you reach your financial goals, it also comes with risks. It's essential to understand and be comfortable with the level of risk associated with your investment choices. It's all about striking a balance between risk and reward. Remember, your investment goals should align with your financial situation and risk tolerance. Just like how every sailor needs a compass to navigate the vast seas, every investor needs clear financial goals to navigate the complex world of investing. To start investing, you'll need a brokerage account. Now, what exactly is this? A brokerage account is your ticket to the stock market, an account that allows you to buy and sell stocks, bonds, mutual funds, and other types of investments. Opening a brokerage account is similar to opening a bank account. You'll need to provide some personal information, like your social security number and contact details, and then you'll deposit money into the account to start investing. There are various types of brokerage accounts to choose from. Some offer full-service options, providing investment advice and portfolio management. Others are discount brokerages, offering fewer services but at a lower cost, which may be a good fit for those who prefer a hands-on approach. Keep in mind, different brokerages have different fee structures, minimum deposit requirements, and investment options. Some might offer a wide range of investment choices, while others might focus on specific types of investments. So, do your homework. Compare the services, costs, and customer reviews before making a decision. Remember, it's not about picking the best brokerage account in the world, but the one that's best for you and your financial goals. Choosing the right brokerage account is a crucial step in your investment journey. Ever heard of the saying, "Don't put all your eggs in one basket"? Well, that age-old adage holds true in the world of investing too. It's all about diversifying your portfolio, a crucial strategy for managing risk. Now, what does diversifying your portfolio mean? Simply put, it's spreading your investments across a variety of assets. It's like hosting a potluck dinner. You wouldn't want everyone bringing potato salad, right? Similarly, you wouldn't want your entire investment resting on the performance of a single stock or sector. Diversification involves investing in different types of stocks across various sectors. Think of it as creating a financial rainbow, with each color representing a different type of investment. You might have some tech stocks, a sprinkle of healthcare, a dash of consumer goods, and maybe even a pinch of energy companies in there. This variety can help to balance out the ups and downs of the market. But why diversify? Well, each sector of the economy reacts differently to market conditions. For example, while the tech sector might be booming, the energy sector could be facing a slump. By spreading your investments, you're not tied to the fate of a single industry. If one sector takes a hit, the others might still be going strong, helping to cushion the blow to your overall portfolio. It's important to note, however, that diversification isn't a guarantee against loss. It's a strategy to manage risk, to smooth out the bumps on the investment highway. There will always be market fluctuations, but with a well-diversified portfolio, these fluctuations might be less jarring. So remember, diversification isn't about chasing the hot stocks or sectors. It's about creating a balanced mix that aligns with your financial goals and risk tolerance. It's about not putting all your eggs in one basket. And that's the beauty of diversification. It's a strategic move to help protect your investments from market volatility, to help ensure that no single market downturn can wipe out your entire portfolio. Remember, Rome wasn't built in a day, and neither is a well-diversified portfolio. It takes time, patience, and a good understanding of your investment goals and risk tolerance. Diversification can help protect your investments from market volatility. Investing in the stock market isn't a set-and-forget activity. It's a journey, and like any journey, it requires regular check-ins to ensure you're still on the right path. So let's talk about the importance of monitoring your investments. You see, the market is a dynamic entity, constantly shifting, and your portfolio needs to keep up. Perhaps there's a sector showing promising growth, or maybe a once-thriving industry is now on the decline. These changes in the market landscape can significantly impact your portfolio's performance. That's why it's crucial to keep an eye out, stay informed, and adjust your investments accordingly. But it's not just about market changes. What about changes in your life? Maybe you've just had a baby, or you're now eyeing early retirement. As your financial goals evolve, so should your investment strategy. Remember, the key to investment success lies in the balance between sticking to your plan and adapting to new circumstances. Regular monitoring and adjusting your portfolio can help optimize your investment returns. Investing in the stock market can be a rewarding journey when done right. We've journeyed together from understanding how the stock market works to the importance of thorough research before diving in. We've also explored the need to set clear financial goals and the process of opening your very own brokerage account. Remember, diversification is key to mitigating risks, so spread your investments across different sectors and asset classes. But don't just set it and forget it. Regularly monitor your investments, make adjustments as necessary, and keep your financial goals in sight. This journey may seem overwhelming at first, but with time, patience, and consistent effort, you'll soon navigate the stock market like a pro. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and turn on notifications to stay updated. Happy investing!